Good day, everyone. I welcome you all from the break. While still in month 3, module 5. Today we're talking about market liquidity. So once again, I apologize for my inconsistency. I needed to take some time to deal with some things. It takes a lot of effort to make these videos. I actually respect those who are out there training, teaching, giving their best in any field at all, be it forex, be it investing, be it business, real estate, or whatever course they are teaching out there. It's actually not easy. But I promise to give it my best and to make sure that I help wherever I can to be very, very, very skillful in this field. So I'd just like to go over this slide again. The 7 steps to becoming a successful trader. The first is the basics, and we are done with this. We trashed it in month 1. And then what we are currently dealing with now is the technical analysis. So month 6, month 5, thereabout, I'm going to be giving strategies on how to trade the forex market. These strategies, you will now take it and then back test, which will now form your trading system. After which you've got your trading system, you demonstrate for 2 to 3 months to test it for yourself. And as you are testing it, you are understanding the market and understanding yourself. How do you react to losses? How do you react to wins? How do you react to when there's no trade to be taken? The basics, technical analysis, strategy, backtesting, trading system, demo trading, all these things help to build your psychology. When everything is done, you can now go into live trading. Now, I haven't been talking much about psychology for a while. I just want to build you here first. When I begin to give the strategies, I'm going to be talking about psychology. A lot of people don't understand what psychology actually is. Many people say the psychology is why you are not profitable, but they don't really understand what psychology is. If you don't have a trading system, you don't have a trading plan, psychology means nothing. And I know the process can be very long. I know that it takes a lot of time, a lot of patience, a lot of dedication, a lot of hard work and sacrifice. You don't do something that doesn't give value. Doing things that are worth your while, doing things that are uphill requires a price. It requires sacrifices. So if you are feeling discouraged at any point, I want to encourage you. This business is not for the weak. It will take you time, but once you get it, you've gotten it. Nobody can take it away from you. If it was easy, everyone would be doing it. So I would like to always tell people that you should do things that many people are not doing. Pay the price that many people are not paying. It will give you the result that many people are not getting. So all the same, if you want anything, you can get it. The only condition is, are you willing to pay the price? So when we're talking about market liquidity, what is liquidity? Liquidity refers to the degree to which a market asset or security can be quickly bought or sold in the market without affecting the asset's price. And look at this chart carefully. I mentioned earlier and multiple times that you find liquidity above and below price. So this high and this low here, here and here is where you find liquidity. Above highs, you find buy side liquidity. And then below the lows, you find sell side liquidity. Now, what is the whole psychology behind this? Now, there are other traders in the market, and there are many people who might have sold from this point downwards. As price continues to move lower, you will expect that stop losses will be placed above these highs here, here, and here. Market tends to seek this liquidity to provide efficiency for market movement. Now, if I have 500 units of euro to sell, and there are only 20 buyers who have the capacity of buying just 50 units of euros, what that means is that my order will not be executed. The highest unit of euro I will be able to sell will be just 50. So I need more buyers to come to the market to be able to buy my large sum of units, which is 500 units. So what happens? I will drive price to where there's liquidity to create efficiency, because now we can assume that I want to sell. But then I would want to execute my order here for a sell. No, they're just how many buyers? A few buyers who can only buy 50 units. So what will be found above these highs will be buy stops. Why are they buy stops? Because there's a stop loss for sellers. And I told you before that when you are coming out of the trade, if you are selling, you'll be buying to come out. So they are called buy stops. So the traders in this trade, they are called stop loss for them. So price will tend to seek this liquidity to grab their stop loss, creating more buy orders to make it efficient enough for them to sell. That is me now to sell my 500 units to drive price lower and make my profits. So market makers move price to where the liquidity is. So if you know where liquidity is, you can anticipate direction of price. You can predict where price will go next. So let's look at price. So you can see how price rally downwards, creating liquidity here. This is what we call relatively equal lows. So now from this point to this point, where's liquidity? This high and this lows. So where the price go to, price came down to grab liquidity below these lows, as you can see here. Now, once this liquidity has been tagged, where can you find liquidity? We can see liquidity here, these highs, and here. And you can see how price tagged it. So now once this liquidity here has been tagged, where's the next liquidity? Here and here. So price rallied downwards, creating liquidity here. And we can see that it was tagged before rallying upwards. Now, so once price rallies upwards, let's say price at this point, where is liquidity? Here, 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 and this point. So we have this high, this low, this high, this low. So we want to use the nearest that we can find. ICT calls it the low hanging fruit. So this high and this high, I want to watch this high and this high. We expect price to either take this high or take this low. Sorry, this high and this low. You can see how price tagged it. So now, if this liquidity has been tagged and price is at this point, where is the liquidity? Here, here, here. We have these lows here, and then we have this high here. But price retraced and then rallied upwards. And this new swing that has been formed created a new area of liquidity, this low and this high. So we want to work with the nearest, this high and this low. So we expect market to tag either of these points here, either above the market or below the market, and it could be both. But we can see here that liquidity was tagged here and liquidity was tagged here. So now price is at this point. Where is the liquidity? We have liquidity above this high, above this low, this low, this low, this low. And then we can see what happened. Price retraced and then took out this liquidity. Now, if this liquidity has been taken, where is the liquidity? We have these lows here, 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 and then this high. This liquidity has not been taken yet. So we expect either of these points. Now, this is below the market. This is above the market. Now, there are many factors you need to put in to know if it is going to be, to know if price is going to take the liquidity above the market or below the market. And you can also tell, there are telltale signs to know if market will run for the liquidity above the market before going downwards or run for the liquidity below the market before going upwards. Now, these things will come clearer to you as you go to the chart and look for these things. What I teach, I want you to go to chart and practice it. Look for them, find them yourself, and then practice them. Now we can see as price continues to rally upwards, it was creating liquidity below the market. See this low, see this low, see this low, see this low. They were left untouched. And then look at how price took out the liquidity above the market before running downwards. Now this happens in all time frames. The central focus here is liquidity is found above and below the market, and price moves in the direction of liquidity. If you know where liquidity is, you know where market is going. Simple as that. When we look at price, regardless of the time frame, we as price action traders, we are looking specifically for reference points. where there is high probability of liquidity resting in the marketplace. And then we can see how this point here it was tagged. Okay, let's move on. When liquidity is taken at the high or low of the market, it is called liquidity run. So I've explained it multiple times. Now, the focus of this lecture, there are two types of liquidity run. Now, I explained to you that when liquidity is tagged, it's called liquidity run. But there are two types. We have high resistance liquidity run. And then number two, we have low resistance liquidity run. What does that mean? High resistance liquidity run means that it is more difficult for the liquidity to be taken. But for low resistance liquidity run, it is easy or the probability is highest for the liquidity at that point to be taken. We have to understand that there are liquidities that are actually easy for market to take and they go effortlessly. Now, when I use the word easy, I'm speaking based on probability. So the probability for a high resistance liquidity to be taken is lower compared to a low resistance liquidity. I hope we just get the picture. So in price action, not all liquidity have equal probabilities. Some liquidity have higher probability for market to get to, while some have lower probability for market to get to. So I'm going to be showing us how to identify high resistance liquidity run and low resistance liquidity run. This helps us decide the trades we take for potential profitable trades. So now we can see that this is an example of high resistance liquidity run. This market here, these lines here, they represent price. You can see it has a lot of peaks and troughs, peaks and troughs, peaks and troughs. It will be difficult for price to run this high because of the multiple highs and lows that you can find here. This blue line here with an arrowhead represents the high resistance liquidity run. Why is that? Because the probability for price to run this high is very low because of this. Picture it like this. Price will have to fight with these highs and these lows. We can see these highs, these highs, these highs before this high, making it difficult for price to run straight to take out the liquidity above this high. And then same for a bearish market because of the peaks and troughs here. It makes it less probable for price to run this high, because this has become a long-term high. Why is it a long-term high? You can see a high formed at the left and a high formed by the right, another high formed by the left that is higher, and another low formed by the right. So just picture it as because of the lows that are being formed and they are progressively going higher. Now, I don't mean to say if you see a market like this is consolidation. You can see that this high is higher than this, but this high is higher than this, and then this high is higher than this. So there's no progressive increase in height. Neither is a progressive decrease in the lows. I hope you understand. But here you can see how this high that was formed, the next high that was formed was higher than this high. Then the next high that was formed here was higher than this high. And then the other side, you can see that the high that was formed here, it was lower than this high. And then the high that was formed here was lower. So we can see that there is a progressive decrease and progressive increase in the highs, progressive decrease in the lows, and progressive increase in the highs in the other side. So we see that this low and this low at both sides forms an intermittent low. Now, if we have this present, it decreases the probability of market running down to take the liquidity below the market. And also we have this present, this structure we are seeing here, where a high is lower at one side, or the left side in this case, and then lower at the other side, the right side in this case. This here, it makes it difficult, like I will say, it's of low probability that price will run this high. So I hope you understand. And don't worry, I'm going to be giving a proper lecture on market structure, and it will help clarify all these things. But for now, I would like us to understand what a high resistance liquidity run is and what a low resistance liquidity run is. Now, this is a low resistance liquidity run. We can see how market created a high, retraced, created a high, and then ran downwards. So there's no peak and trough here, just one single move. This here, it is a low resistance liquidity run, meaning that the probability for price to run to take this high is high because there is no wicks and trough, no highs and low to protect this long-term high here. So we can expect price to easily, with high probability, run to take this high. Same for the bearish market. You can see that market created just this low here and then rallied upwards with no peaks and troughs, no peaks and troughs, no noise. So we expect that price will easily and with high probability run down to take this low. So let's go to the chart. Now this is the live market. We can see how price created that structure I explained. The low to the left is higher than the low in the middle, and then we see another one here again. And then price rallied here, retraced to create a trough, and then rallied to create a peak, rallied to create a trough. And then we can see this peaks and trough here. So we can look at how price retraced down to take liquidity, but this low was protected. At this point, the likelihood of price running down to take this low is very low because of these highs, these lows, these highs, these lows that has been formed. But look at this point. Look at what happened here. Look at how price ran down here. It doesn't have that wick and trough as much as the price action here do have, because you can see here, this low is higher than this low. This low is higher than this low. So it formed that pattern here, formed that same pattern here, which will protect this low here. So it's just something like this. Let me just draw it out quickly. You can see that three candle pattern formed here, then the same formed here, formed here, formed here, then the same formed here, and formed here. So this is also forming the three candle pattern, making it more difficult for price to run down and take the low here. Okay, now this is looking like a bunch of faces, but I don't want us to be distracted. I want us to just see the three candle pattern here. It was formed here, so we can see this low and this low here. This is one. We can see this low and this low here. So this is the one on the right side. And then we can see something here, the same thing at the left. So we can see that this here is the telltale sign telling you that it is not difficult, to be more difficult for price to run down and take this low. We can see how this low was protected. And it doesn't mean that price will not run, can never run down and take this low. No, we use this to read price to know the likelihood of where price will be going to. Now, price usually, the probability for price to run down to take this low after which this pattern has been formed, the probability is very, very low. Instead, we want to aim for trades where there is little peaks and troughs. Something like this run down. Let me just take out all this drawing. So you can see this drawing down. We don't have much of it. Price just came down. Don't be deceived by these highs here. These highs that you can see. Don't be deceived by it. If you look at it, that candle pattern wasn't from this three candle pattern. It wasn't formed. So let me move the chart. And you can see how price rallied easily to take out. So this liquidity here, this run here is low resistance liquidity run. This run here is high resistance liquidity run. And look at how price delayed. You can see this delay in price run just to take the liquidity here. But you can see the swiftness, the ease. You want to be in this type of trade. You don't want to be trading. Now you can see this will take how many days? Let's say you want to trade from here just to take this low. To take what is Wednesday and then this is Friday. But just on a Monday, you can get this right. So look at how it moves swiftly to take out liquidity here and here. Now, you will see that price took out this low. And then took out this low. But then again, it began to form that pattern. So you can see, let me just draw it out. You can see this low, and then this low. So price rallied, retraced, rallied, retraced. Now, once you start seeing price rallying and protecting the lows, you want to be buying, not selling at this point, because the probability for price to reach down to this low is very, very low because of the wicks and troughs that you can see here. So you want to be buying. So these peaks and troughs created here will make it difficult for price to run down to take this low. And you can see this pattern formed here again. Here, here, then here. As we continue to move, you can see that price continues to go higher and higher. You want to be buying. You want to be aiming for the highs, the buy side liquidity. As these lows are forming, they protect this intermediate term low. Now, we term this as high resistance liquidity run. But this here, this move is low resistance. There is little resistance because why? There are no much peaks and troughs. And this is the physiology behind trends. You see price moving in trends. Let me draw it out. You can see price move this way and then began to form a trend like this, like this. Price will continue to go higher. Why? Because these lows here make it difficult or decrease the probability for price to go downwards. Now, there are exceptions. There are other things that can make price to even run down to take this low, regardless of these peaks and troughs, like high impact news, bombing, crisis, or wherever. Okay, so let's continue. You can see how price continue to rally upwards, rally, and then to this point. Now you can see that formation forming here again, this high, and then the highs at the left and right are lower, and then we see the formation here again. So as price continues to break down, you want to be selling. So I'm not saying that when you see something like this, you sell. When you see something like this, you buy. I'm saying that how you can tell high resistance liquidity and low resistance liquidity one is when you see this price action forming. So now let's say today you want to take a trade. Likely part of the things you want to add to your analysis if you see this is you want to be selling amongst other factors. You don't just pick this alone and say you want to sell. You add it to your repertoires, to your toolbox to help define a bias for you for that trading day, or if it is a trading week, whatever time frame you are using. So you just add a lot of things to give a refined analysis for your bias. So we can see how price continue to rally downwards. Look at price. When price is running upwards, you can see the difficulty when price is running upwards. But the speed at which it rallied downwards is huge. Then now you can see here again, price struggled, and rallying upwards, and then swiftly rallied downwards. And then price struggled to rally upwards, and then swiftly rallied down. When you start seeing this, it is telling you that price is bearish. You should be selling. It's the telltale sign that you can use to read price action. So I'm teaching you how to read price actions, not using indicators, because indicators are just mathematical representation of what price has already done. There's no need for indications. You can look at price, read pure price action, and then tell where market is going. And I've explained to you that market seeks liquidity. So the liquidity above this high is high resistance liquidity. So you don't want to be aiming for liquidity here. You want to be aiming for liquidity below the market. You can see liquidity here. And look at how price grabbed it. You can see liquidity here and price grabbed it. See liquidity here, price grabbed it. You can see liquidity here and then price grabbed it. At some point, you're going to look at price action and it's going to be crystal clear that the more price action there is around a specific level or a high or a low, that is indicating a level being defended on an institutional price model. So I hope you understand. If you don't understand, please feel free to ask questions on the group. You can send me a direct message and I'll answer you gladly. And as always, I wish you all good luck and good trading.